So that comes back to the issue over competition for assets. So whenever there's a global champion or a domestic incumbent that's for sale with high barriers to entry and solid cash flows, there's a lot of competition from the IPO markets and from global strategic investors for those assets. They typically have lower return requirements than financial sponsors, and they typically have lower costs of debt. So the sponsors have been outbid by the IPO markets and the strategic investors, and so they've had to look for alternatives to find assets. And so they're looking at companies that offer growth. So they're still employing high leverage, 6 times debt multiples are what we're observing in 2015, and that's very similar to 2006, 2007. But those debt multiples are going on companies that are in cybersecurity, for example, or payment systems. We had a very successful IPO of a leveraged buyout called WorldPay, and those companies are demonstrating both growth and pricing power, and sponsors are willing to pay higher multiples for that. On the other side, you also have more value among smaller companies in Europe. And so sponsors are combining those small companies and trying to generate growth by extracting synergies and building larger companies and generating higher multiples when they want to exit.